I'm Frank Pina, and joining me today in the studio is Lee Boss, leader of Mercadien's Transaction Advisory Services Group. Hi, Lee. How you doing today?
Good, Frank. Yourself?
Terrific.
Pleasure to be here.
Thanks for joining us. At this point, the topic of the day is selling your business, and how does one go about evaluating what it's worth, right? At the end of the day, it's probably worth what a willing buyer is willing to pay for it. But too often, in my experience, business owners have a misconception about what their business is actually worth versus what it's going to sell for. Right. So, how do you advise your clients in terms of putting a realistic value on their business so that they can reasonably expect through a process?
Yeah, it's actually a really great point you make about being realistic about the valuation. And all too often we see business owners that think they're either going to get 20 times multiple and extraordinary valuation for the business, and then the reality is much different. Or it's the opposite, where they actually don't realize how much the business is actually worth, and they end up getting an unsolicited offer from somebody and they think, wow, this is great. Meanwhile, the buyer's actually trying to undercut them on valuation. So the question of valuation is really key and fundamental to M&A and transaction advisory services. And it's really critical. As part of our team, we have a valuation specialist that can come in and actually evaluate the business and come up with a valuation. Those valuations are based on a number of different things, but fundamentally it's based on actual market transactions that have occurred in that industry, as adjusted for a lot of different things, unique for that business. Are they, should they get a premium on their valuation because, for example, they have a diversified client base, they have a well-established workforce, they have some kind of secret trade patents, things like that make their business really unique? Or should they be discounted from those historical, those market trend valuations because, they don't have they have one client, one customer, they're not diversified, they have kind of profitabilities trending downward, those type of things. So the valuation, really understanding what the value is, critically important as part of, advising a client and talking about, should I sell? Is it the right time to sell? The other thing, there's general market trends out there that are used, or multiples on things. For example, earnings before interest, taxes, depreciation, and amortization, which is commonly referred to as EBITDA. So there's general kind of times EBITDA multiples in certain industries that we can get through our valuation specialists, also from investment bankers and brokers that are seeing a lot of transactions out there in the marketplace. It's really important that you understand, though, that those are based on an industry similar to yours and then adjusted for various variables. Again, could be a premium on that if you are doing things better than, say, the average market participant, or there could be a discount if there's certain issues that would warrant that discount.
So it sounds like valuing a business is really maybe more of an art than it is a science, and a value maybe is best spoken in ranges.
Yeah.
At least at that stage.
Yeah.
Before you take your business on the market.
Yeah, and it's interesting because ultimately it comes down to what somebody willing. There's a willing buyer and a willing seller, right? So, which really is a critical aspect of going out to market, doing more of an auction environment where you can get multiple offers at once. Because to really understand what this business is worth, having multiple interested parties bidding on that will determine what the value of the business ultimately is. So we can say, well, this is what the trend has been for other businesses, or the past 12 months is what a business in your industry has sold for. But it's really, as you said, it's kind of an art more than a science.
And we also hear the term strategic buyer versus financial buyer. Can you talk a little bit about what that represents and maybe the differences?
Sure.
And as it relates to the impact to the business owner, who may be willing to pay more under what circumstance?
Yeah, the trends have actually kind of varied between, who do you get a better deal for, a strategic or a financial buyer. But generally, when I think of a strategic buyer, I think of somebody that's kind of already in that industry or wants to get into that industry. So it could be one of your competitors or peers in the marketplace, or someone that is in business but they don't quite do what you do, but they'd like to bolt that into their business, and
so
it'll
your
be
business
accretive
might
for
be
them.
Accretive, right?
Correct. It'll be accretive to them. And typically strategic buyers have been willing to pay more for that because they can see that, one and one, what one of my business partners, Myron Gelman, always like to say, 1 and 1 is not 2, it's actually 11. So that's what a strategic buyer is really looking for, is to create those, what we call merger acquisition synergies. A financial buyer is more what you would think of your traditional private equity, where they're going to come in and their ultimate goal is to kind of use your business. Either they already have an existing platform company that they're going to bolt you into, similar to the way a strategic would, or they're going to have you set up as a platform company, and their goal is to acquire other companies to kind of create those synergies. But they have an end plan. They have an end plan as far as an exit strategy. It could be 5 or 8 years, which is typically the plan, where they want to, after 5 or 8 years, actually sell that your business again.
And is that what I hear? The second bite at the apple is usually what takes place in that situation?
Yeah, so they want to either sell it, maybe now they're going to sell it to a public company, or they're going to sell it to a strategic buyer, or maybe they'll sell it to another private equity group, that has more capital, that will pay more for that, and kind of rinse and repeat. Mm-hmm. So the second bite of the apple is really this concept where, as a business owner, you can sell your business but still retain some ownership interest in the fund that buys you. So the goal is, if you have really a great outlook, a good private equity group, you believe in what they want to do with your business when you sell it to them, you can actually get some ownership interest in that fund. So now 5 to 8 years when they sell, not only did you get your sale proceeds when you sold it 5 or 8 years ago, but now when they sell that fund with your company as part of it, now you also get proceeds as part of that.
So leaving your equity in early, in theory, will pay significant dividends 5, 8 years later.
Correct. Yeah.
Understood.
But it's, there's unique benefits and things to consider, and things that could be disadvantageous under both, a strategic or a private equity. So, which is really why it's important to have kind of this robust process, not just receive an unsolicited offer, but actually going through more of an auction rate process where you get multiple bids and offers. And those will be both private equity and hopefully strategic buyers. So you can really evaluate the whole population offers that you have, as far as, which one's better, which one has maybe some risks associated with it, which one, satisfies my overall objectives the best.
Well, there you have it. Pros and cons of evaluating how to value your business, as well as which type of partner to market your business to. Lee, thanks for joining us, and we'll be back again with more knowledge and insights in short order. Thanks again. Take care.